one, go.
Hey everybody, this is episode 2 of Tailwind TV, talking about Tailwind Wealth Management that is run by my very good friend, Doug, the genius Beck. How you doing, Doug?
I'm a genius today. That's good.
You
Can you tell
are,
my wife?
you are. I've been telling you that since we were 11, so. But, so I'm in Raleigh, you're in Boston. The whole world's dealing with coronavirus, so I know we're going to be dealing with some of those subjects and kind of the mentality about what's going on in the world today because of all the financial real impact and scare impact and all of that. But we had talked about what episode 2 should be about. So let's talk real quick and get people on kind of a baseline about types of investments. Does that sound good today, Doug?
Good idea, Rob.
Okay, so when we're talking about the basics of how do most investors invest their money?
So, there's probably an encyclopedia of ways you can invest your money, but the very basics, if we boil it down to the building blocks, stocks and bonds, right? Stocks are also called equities, and then bonds are sometimes referred to as fixed income. They act very differently. A company can issue both. Essentially, a stock or the equity of a company is junior to the bond of a company. So why I mention that, it's very important today that investors understand this. If a company goes into bankruptcy, equity holders are wiped out. The stock can go to zero in the bankruptcy. The fixed income or the bond holders may come out with part of their investment, perhaps not all, but they're senior to the stockholders. So that's probably more detail than you wanted. Other types of investments take those stocks and bonds and think of it as packaging them. So they'll put them into what's called mutual funds. Mutual funds are a legal structure that own sometimes hundreds or even thousands of stocks and or bonds. And then their kissing cousin, the ETF, which is an exchange traded fund, which is very similar to a mutual fund. It just trades on a stock exchange, whereas a mutual fund does not.
Okay. Gotcha. And you had mentioned passive and active investing. So what are the differences between the two, and are there ways to figure out which is better for you?
Right. So passive investing means basically an investor owns an index like the Standard & Poor's 500 or the Dow Jones, or there are dozens, if not hundreds of them. And you always have the same stocks or the same bonds, whichever may be the case, in that mutual fund, for example. An active mutual fund, you have a portfolio manager who is making active decisions on whether they go overweight or underweight. And underweight can mean they don't own the stock at all within a given investment objective. So, if the target is to outperform the Standard & Poor's 500, right, the active fund may only own 300 of the names in the Standard & Poor's 500 and will weight them differently than the index is weighted. So it's become a very hotly contested debate in the industry for actually well over a decade. Obviously, portfolio managers feel they can add value in active management. It is historically very difficult to outperform a passive benchmark because you have transaction fees, you have taxes, there are all sorts of little, detractors that can come into effect and impact your return in an active fund. But there's also the ability to take an overweight position in a company you have conviction around and perhaps outperform.
Gotcha. And then you mentioned an acronym ETF. So remind me what ETF stands for, and then what's the difference between mutual funds and ETFs?
So an ETF, they've been around, I want to say going back to the late 80s, if I'm not mistaken, and they become extremely popular today. Their growth has even outpaced many areas of the mutual fund industry. It stands for Exchange Traded Fund. So it's very similar to a mutual fund. They're each made up of underlying securities. But an exchange traded fund, as the name implies, trades on an exchange like the New York Stock Exchange, whereas a mutual fund does not trade on an exchange. And basically a mutual fund, if you purchase a mutual fund today, Wednesday or Thursday is today, you'll get the price at 4 o'clock when all the securities are priced at 4 o'clock. If you
Okay.
sell, same thing, you get the price at 4 o'clock. An ETF is trading from 9:30 until 4 o'clock. So as the market goes up and down throughout the day, an ETF has liquidity throughout the day, whereas a mutual fund does not.
Okay, and the times you're talking about are right now Eastern Daylight Time?
Correct.
4
Right.
p.m.?
The equity markets are open from 9:30 a.m. Eastern until 4 p.m. Eastern.
Gotcha. Okay. And you had said that ETFs sometimes get criticized. Are they problematic to work with, or?
Well, you know, it's not surprising. Oftentimes criticism comes from the competition, right?
Oh, right.
Um, so, you know, I mean, some of the criticism is accurate and is fair, but you can be critical of any structure. There's no perfect structure. What's important is investors understand what the perhaps chinks in the armor might be. For ETFs, the challenge could be and has been recently in certain areas of the market, like high yield bonds. High yield bonds, otherwise called junk bonds, sometimes can be very illiquid. They just don't trade that frequently because there aren't a lot of, let's say, company XYZ's, you know, 10-year, you know, below investment grade rated bond. Maybe the company just didn't issue that much. So if you're seeing a spike in trading volume of an ETF, and an ETF has to what's called redeem part of its portfolio, it may have to sell those bonds in an illiquid environment. Even municipal bonds recently hit a period where, given this crisis that we're in with the, you know, COVID virus and whatnot, bonds are trading less liquid. Even treasury bonds are trading less liquid. So you had the bid-ask spread gap open, and a lot of these ETFs got caught where, you know, their underlying value was not in sync with the market value of the ETF trading on the exchange, and that can be troublesome. It's very detailed, as you can tell, but investors expect to get almost exactly what the underlying securities are worth when they're trading an ETF. And if they're getting 8% less than or 10% less than what it's truly worth, that's obviously not a good thing. It doesn't happen too often, and it's only in these less liquid areas of the market that you tend to see it at all.
Okay. And there's also SMA, what separately managed accounts, is that right? So
You nailed it, Rob. You nailed
yay,
it.
I'm getting it a little bit at a time.
I'm feeling the competition.
Well, I work in the IT world. I can handle some acronyms over
Yeah,
time.
you can toss those out with the best of it, right?
But
Yeah.
what are the advantages and disadvantages of separately managed accounts or SMAs?
Well, so, you know, think of it as kind of a, you know, a life cycle of product. Wall Street is probably full of, you know, more innovators than any other industry. You know, Wall Street has figured out more ways to create things that sometimes clients really even don't need. Not to suggest SMAs are that, but SMAs were an evolution. So we went from back in the 70s, the first mutual funds started to become more popular. And before that, you were just buying stocks and bonds directly. It was very expensive. Mutual funds became kind of the main street investment for retirement accounts and 401ks. And then in the 80s, you got ETFs come to light. And then, you know, the advisory space started to look around and they said, well, what about the higher net worth investors? They don't want to feel as if they're owning just this plain vanilla mutual fund that everybody else owns. So why don't we give them customization? And the separately managed account industry was born. And it required really the technology that really was not available until, you know, really going into the 90s, the computing power necessary to manage hundreds of thousands of individual accounts, each
Right.
with specific exceptions. One client may not want sin stocks. Another client may have a specific tax sensitivity. Another client, the list goes on. So they would take a general template of, let's say, investing in large cap stocks, and then they would customize it around the edges for these clients, hence the name separately managed account. And the client would be able to see each of the underlying stocks or bonds that the advisor purchased. And at the end of the year, they would be able to say, well, I need to generate $3,000 or $5,000 in losses to offset my capital gains. And then the advisor goes in there and hand picks the securities, and voila, you have the SMA industry.
Huh. And okay. So yeah, let's talk more about that in future episodes, because it sounds like something to be aware of if people are going down that path, and or
Mm-hmm.
if they're working with people who do go down that path. So you and I started talking about yield, and if you would, for our friends, define yield. That's what everybody's looking for in the investing world, right? But with, as I understand it from you, if Fed rates are dropping to pretty much zero, where does yield come from? So could you take us through that?
Yeah, so this has been really one of the most challenging things over the last several years, and probably several is an understatement, right? So especially when you have retirees that really want to live off of a paycheck, and they don't want to aggressively dip into their capital base, their
Right.
initial investments. And the cost of living is going up, whether it's housing. We talked about healthcare before. Everything is more expensive, yet interest rates keep declining. So, while on the one hand, we view declining interest rates as good, mortgage rates go down, credit card rates go down, et cetera. On the other hand, it's really negatively impacting a large segment of the population. And what happens, unfortunately, all too often is that individual investors are stretching for yield. They're reaching too far down
Hmm.
in credit quality. They're taking on risk that they don't understand, and it's really a trail of tears in terms of number of examples that I could give, going through how much damage has been done in mistake after mistake. The products that were offered in the past that people thought were going to be CD-like, certificate of deposit-like, or money market fund-like, and they were really much different. And just for an extra 0.1%,
Right.
they ended up losing multiples of that in depreciation on their investment. So you need to be very careful. Very long-winded answer. Recently, even money market funds, right? I mean, people view money market funds as safe as being in the bank. Certain companies closed money market funds to new investors over the past week or so,
Oh,
because the rates, the Fed brought rates so low that these companies viewed existing investors in these money funds as potentially being harmed, because they would have to buy almost zero yielding securities and dilute the fund. So what do
yeah.
clients do? I mean, that's getting back to your question. Um, they can do a couple of things. You can go out there and you can buy treasury bonds or treasury bills at the treasury auction for zero commission, no transaction fee. Anybody can do that. You can go out there and you can buy certificate of deposits or CDs.
Right.
Those are becoming actually quite difficult to find, or more difficult to find. I noticed recently I hopped on my custodian's inventory of CDs, and what would typically be a list of 20 or 30 CDs was less than 10.
Wow.
Um, banks don't want more cash. They do not want to lend, and it's really symptomatic of the tough climate we're in right now.
Right.
Let me say one more angle here, and you may have some questions on this, but
Okay.
another way to achieve yield is through dividends. And dividends are payments that companies make to stockholders, basically
Right.
like almost like a bond coupon. But since the market prices have been hit so hard. The stock market's gone down so much. You have utility companies, you have large manufacturing companies, you have banks, financial companies. The list is long that are yielding. Real estate investment trust is another area. Each has its different risks, right? But if you put together a diversified portfolio basket of these stocks, you can get dividend yields blending out as high as 4, even 5%.
Hmm.
So if you can ride through the volatility, not look at your portfolio every day, every minute, and just if you're in it for 5 or 10 years, during which time the market should hopefully recover by then, right?
Sure.
In the meantime, you're getting a very nice payment on top of potential appreciation.
Right on. So why doesn't everybody just do that all the time? It's all about that risk factor that we talked about last time.
Right. So, great question. I mean, there are a couple of reasons why. First of all, they may not have the stomach for watching their balance go up and down. Last month, the average, the S&P, for instance, I believe was averaging plus or minus 4% a day. I mean, that's gut wrenching.
Wow.
Another reason might be because, a high dividend could always be cut, or any dividend could be cut.
Okay.
And what many companies are doing now is they're retrenching and they're saying, wait a minute, are we going to pay out what's now a 7% dividend when if we cut that dividend back down to 3.5%, we could keep another 10,000 workers on, right? Or do we fire 10,000 people just to make the dividend payment? It's really, we're down to dire circumstances right now. So dividend cuts could very well be in the cards for a lot of these companies. Even if the companies are healthy, they're making capital allocation decisions for the future.
Right. And like you said in one of your recent podcasts, that it's basically sometimes the answer is to do nothing. But yeah, I recognize there are a lot of people that are kind of looking at the tickers and freaking themselves out about it, right?
Yeah, yeah.
So, and you mentioned diversity. Does that include, or should it include alternate investments? What are those kinds of options, and what kind of exposure can and should investors be looking at?
Right.
Yeah.
So the alternative investment space, that's kind of the code word for what used to be called hedge funds. Now,
Oh, okay.
hedge funds are really only available to what are called qualified investors, and those would be investors that are making, can prove that they're making a certain amount of money every year, can prove that they have a certain net worth, both or one or the other. So they're not available to most average investors, which is probably a good thing in my opinion. I think that many hedge fund type structures are way overpriced. They're too expensive. Many of them have taken a 2% management fee and 20% of the profits per year. So, if they make 20% for you, they're getting 2% off the top, and they're getting 2% of 20% or 4 additional percentage points. You're getting 6% total off your 20. So your 20 goes down to 14. That to me is just, that's egregious. So some of these strategies have morphed or migrated in one way, shape, or form into the mutual fund or even the ETF space. And that's where we call them alternative investments. Now, it's a kind of a loosely cast phrase. You can also, some advisors throw real estate into alternative investments, the category. Some may even include gold or precious metals, broadly speaking, into alternatives, or the strategies like market neutral is one. Long short is a related strategy to market neutral. And in those cases, they try to basically hedge out the direction of the market and just get that incremental stock picking value that they hope to generate. I guess just to wrap up on that, what I would say is in some cases they're warranted. but it's almost like putting a little seasoning on your steak. Don't dump it on. Use it sparingly. It's a good diversifier, which means that it should lower the volatility. The purpose should be to lower the volatility of your overall portfolio. It shouldn't be in the driver's seat. Um, and even in this new format that's delivered through a mutual fund or another type of wrapper, I call it, even oftentimes then they're too expensive. So you need to look very closely at how the underlying fees are structured.
Gotcha. Cool. This is a lot of good information today, Doug. Thank you. And we will talk some more soon. And folks, you know, Doug's been trusted with a lot of money over his career for a good reason. We'll talk about that a little bit more next time. But if you want to get hold of him, I'm sure his contact information will be somewhere around this video for you to get hold of. And yeah, I mean, ask the questions. It's better than either doing nothing and wondering why you didn't do anything down the road, or you know, going out there willy-nilly without somebody who really knows what they're doing and does definitely have your best interest at heart. Doug's proven that as a person and as a professional for, well, a lot of my life. And so, Doug, thank you. Appreciate this. And more Tailwind TV coming your way soon, folks. Have a great day. Thanks.
Thanks, Rob.